Kevin Warsh has just been named the 17th chair of the Federal Reserve. From the moment he took office, a 32-day countdown began. His first official Federal Open Market Committee meeting is set for June 16th. He is walking into an absolute mess. Inflation remains stubbornly high, energy costs are climbing, and real wages, what you actually take home after adjusting for inflation, are strictly negative. People might be earning more on paper, but they are buying less. The political environment is just as fractured. His confirmation saw a 51-45 Senate vote, the most polarized in Fed history, with figures like Senator Elizabeth Warren openly calling him a puppet. Between the economic strain and the political firestorm, Warsh has promised a total regime change. This is a massive, highly volatile gamble with the global economy. His plan relies on a bizarre contradiction. He intends to cut interest rates, which typically stimulates the economy, while simultaneously aggressively shrinking the Fed's balance sheet. The target for that reduction is extreme. Warsh is aiming to slash the Fed's balance sheet by an astonishing 40%. This chart shows the stark difference in scale. Back during the quantitative tightening cycle of 2018, the Fed attempted to shrink the balance sheet by just 15%. That relatively modest move coincided with a near 20% drop in the S&P 500. If pulling 15% of the liquidity out of the system cratered the stock market, draining 40% risks a catastrophic pullback. Investors celebrating the prospect of incoming rate cuts are walking straight into a trap. To understand why this is so dangerous, you have to look at the financial habits of the last decade and a half. Since 2008, global markets have relied on easy money, expecting cash injections to bail out the system whenever things get shaky. Warsh wants to break that cycle. He frequently references Paul Volcker, the chairman who took brutal, immediate action in 1979 to crush inflation, regardless of how much economic pain it caused in the short term. The Fed's balance sheet acts as two interconnected liquidity pools, the Fed's government bonds and the commercial bank's cushion. When that commercial cushion drains, credit dries up, and the market is starved of liquidity. When full, banks lend freely, and money floods the system. Everyone focuses on the highly publicized interest rate announcements, but the true mechanism of economic control is in the hidden plumbing of these reserve accounts. That brings us to Warsh's QT for cuts strategy. He plans to give politicians the interest rate cuts they are screaming for, while quietly using quantitative tightening to pull over $2 trillion of liquidity straight out of the economy, and he intends to do it entirely in the dark. Warsh has openly criticized transparency tools like the dot plot and forward guidance, meaning the Fed is going to communicate far less about its internal moves, with the central bank intentionally obscuring its strategy. Relying on standard news cycles to guide your portfolio will leave you completely exposed. If you need a systematic way to track these macro changes, you should join the Stewardship Finance Academy. We offer a free stock investment masterclass designed to help you build a resilient asset allocation strategy. You can find the link in the description. When the people managing the money supply decide to hide their actions, independent financial education is the only reliable way to protect your wealth. The institutional players on Wall Street, the smart money, are already positioning themselves for this exact scenario. We are seeing long-term treasury yields climb steadily. The market is pricing in the reality that the Fed is stepping away and will no longer be there to absorb the massive supply of government bonds. At the same time, bank stocks are outperforming. Institutional investors are betting on a steeper yield curve and the likelihood of future deregulation under a new regime. But there is a glaring red flag in the data. Valuation metrics, specifically the Shiller-Cape ratio, have reached historic peaks, levels we haven't seen since the extreme market bubbles of 2000 and 1929. Warsh might deliver a few short-term rate cuts to satisfy the public, but cheap borrowing costs cannot save a market if the foundational liquidity keeping it afloat is being quietly vaporized. When systemic uncertainty is this high, sometimes the most aggressive move you can make is to retain your cash and wait. Look at Warren Buffett. He is currently sitting on hundreds of billions of dollars in cash. He isn't holding it because he's terrified of the market. He is holding it because he knows the value of keeping his powder dry until the right entry price appears. We are rapidly approaching June 16th. The window to clean up your portfolio and prepare for the fallout is closing. Keep your capital safe. stay highly vigilant, and continue learning. I'm James, and this